For a long time, silver has lived in the shadow of gold. It was familiar, widely traded, and often discussed, but rarely taken seriously on its own. Recently, that has begun to change. What I want to talk about today is not a short-term rally and not a forecast. This is about a shift in how silver is used, how it is supplied, and how it is increasingly being valued. And more importantly, what that shift implies.
Before we begin, one note. This is not a call to action, nor a trade recommendation. It's an explanation of how a familiar market may be changing and what that change implies. Listen for structure, not signals.
Silver has always been treated as a relative asset. Its relevance was rarely discussed on its own. It was measured against gold, compared across cycles, and explained through ratios. That framework worked until it didn't. What has changed is not sentiment alone. What has changed is function. Silver today is being pulled in two directions at the same time, as a monetary metal and as an industrial input. And when an asset starts serving two masters, the old reference points begin to fail. This is not about short-term moves. It is about understanding whether the old ways of interpreting silver still apply. What it will give you is clarity. Clarity on whether participating at all makes sense for you, and what kind of risk you would actually be taking. For decades, the market relied on a simple relationship. Gold represented stability. Silver followed, with leverage. That relationship was captured in a single measure, the gold-to-silver ratio. It became a shortcut for valuation, a way to judge whether silver was cheap or expensive, not in absolute terms, but relative to gold. For a long time, that worked remarkably well. But relationships only hold as long as the assumptions behind them remain intact. When you look at the relationship over a long enough horizon, something becomes clear. The gold-to-silver ratio did not just fluctuate, it changed character. What used to be cyclical became structural. Extremes stretched further, and normalization took longer. This was not a temporary distortion. It was a signal that the old balance was no longer able to reset itself. For most of modern history, silver was understood primarily as a monetary metal. Its demand was driven by inflation expectations, currency credibility, and investor psychology. That role has not disappeared. It is no longer sufficient on its own. Today, silver is also a critical industrial input, embedded across energy transition technologies, electronics, and efficiency-driven applications. This is not diversification of demand. It is a layering of demand. And layered demand behaves very differently from speculative demand. Relationships do not break randomly. They break when the forces on each side stop moving in sync. In silver's case, demand began to change faster than supply could respond. New sources of demand emerged, and they were no longer purely financial. Silver started to behave less like a derivative of gold and more like a metal with its own physical constraints. When that happens, historical reference points lose their anchoring power. When prices rise, the instinct is to expect supply to respond. In silver, that assumption is weak. Most silver is not mined because of silver itself. It is produced as a byproduct of copper, lead, zinc, and gold mining. That means higher silver prices do not automatically translate into higher silver output. Supply responds to the economics of other metals, on different timelines and for different reasons. This makes silver structurally inelastic in a way the market often underestimates. Roughly speaking, silver does not control its own supply. The majority of global production comes as a secondary output tied to other metals. Decisions to expand or contract supply are driven by different demand cycles, capital budgets, and margins.
Even a strong silver market cannot compel new production on its own. This creates a lag, and when conditions tighten, that lag becomes a bottleneck.
When layered demand meets inelastic supply, the outcome is not immediate. For a time, the system absorbs the imbalance. Inventories adjust. Investment demand comes and goes. Volatility remains noisy. But as industrial usage scales, the margin for error narrows. Eventually, the system stops buffering pressure. It begins transmitting it. That is when price stops being noise and starts becoming a signal.
Seen through this lens, the breakdown in the gold-silver ratio becomes easier to interpret. This was not gold asserting dominance. It was silver decoupling from an outdated reference. The ratio stopped reflecting relative value and began reflecting structural stress. What appears distorted is not disorder. It is adjustment, delayed, uneven, but directional. Once that adjustment begins, it rarely resolves quickly. Although the pressures built over many years, the break itself was not gradual. It clustered in a narrow window just before 2020. Industrial demand accelerated, supply flexibility narrowed, and financial markets became less effective at smoothing the imbalance. What followed was not the cause of the move. It was the release of pressure that had already accumulated. When price finally moved, it appeared sudden, but it was not spontaneous. The rally was the system catching up to a reality that had already formed. Structural imbalances do not resolve smoothly. They remain quiet until recognition arrives. What followed was volatility, not as excess, but as the cost of delayed adjustment. After a sharp move, the natural question is whether the drivers still apply. In this case, very little has reversed. Industrial demand has not normalized downward. Supply has not become more flexible, and substitution remains limited in critical applications. The forces that created the imbalance are still operating, even if their visibility fluctuates. Entering 2026, silver operates in a different environment than it did in prior cycles. Monetary uncertainty has not fully resolved. At the same time, industrial demand has become structurally embedded. These forces now coexist rather than alternate. That balance did not exist in the same way before. It changes how stability, volatility, and valuation interact. This thesis is not unconditional. A faster-than-expected normalization in monetary conditions could produce safe haven demand. On the industrial side, efficiency gains or substitution could limit silver intensity over time. These risks do not reverse the structural case. They define its boundaries. Because outcomes are uncertain, positioning matters. This is not about precision. It is about asymmetry. Silver offers exposure to a structural shift where downside is constrained by cost and usage, and upside is driven by recognition and scarcity. That is the definition of optionality. You are not predicting an outcome. You are choosing to participate if the shift continues to express itself. At this point, the natural question is whether to act now or wait. The honest answer is that timing is usually the wrong decision to make first. The real decision is whether you are willing to live with volatility, incomplete information, and long stretches where nothing seems to happen. If that feels uncomfortable, waiting does not resolve it. It only delays the same decision. Optionality does not require a single expression. Exposure can be direct or indirect, physical or financial. Each structure carries different trade-offs: liquidity, volatility, and sensitivity to price. The important point is not the instrument itself.
It is the alignment between structure, risk tolerance, and time horizon.
Structural shifts do not reward everyone equally. They favor patience over precision and tolerance over certainty. This is not an allocation for those seeking smooth paths or immediate validation. It requires comfort with volatility and the willingness to hold through ambiguity. For the wrong expectations, silver can be frustrating. For the right expectations, it can be meaningful. This was never about a single rally. It was about a shift in how silver is used, how it is supplied, and how it behaves when pressure builds. The implications of that shift do not appear all at once. They surface over time, in pricing, in volatility, and in how silver is understood. Recognizing that change is more important than trying to pick a moment.
If you're watching this and wondering whether you're late, that reaction is natural. Strong moves always create urgency, but markets rarely reward decisions made to relieve that feeling. Silver offers potential through repricing, not precision. The real question is not where price goes next. It's whether you are prepared for the volatility that comes with the opportunity. That answer is different for every investor. Thank you for spending the time. I hope this gave you a clearer framework for thinking about silver. Until next time.